Thank you very much. It's a great pleasure to be here. Thank you for the invitation. Thank you for the introduction. And thank you for putting up with the English language. I would very much rather be able to speak in Swedish to you. Hopefully, as we expand our cooperation, there will be many more opportunities, and so perhaps I can learn another language, which I very much enjoy, actually. Now, I would like to talk to you about banking. I'm professor of international banking. I'm trained as an economist, macroeconomics, monetary economics, but for the last 10 years I've been professor of banking at Southampton, and of course these are very much related disciplines. Economics and macroeconomics has for most of the last 40 years ignored banking. So when the banking crisis happened, and when we say the banking crisis, then we're referring to the North Atlantic banking crisis emanating from the US in 2008. A lot of journalists wanted to ask some leading professor of economics for a comment, which is quite reasonable when you have a massive crash on Wall Street and banks going bankrupt and pandemonium in financial markets. And so you can imagine the scene of a Wall Street Journal journalist calling up, who's the most famous economist at MIT, Harvard? Okay, call them up, professor of economics. Please, what's going on? Can you please comment? Now, the honest answer by the professor would have been, no, I can't comment. Oh, why is that? Surely, you're the most famous professor of economics. You received even what is usually known as the Nobel Prize in Economics. Of course, we know it's the Riksbanken Prize in Economic Sciences in honor of Alfred Nobel, which the Nobel family is not so happy about, but that's another story. So you've even got these prizes. Surely you can give a comment. No, I can't. Why not? Well, my theories and my models do not include banks. Excuse me? That is the reality of leading economics in the leading universities all over the world, in the textbooks, macroeconomics. So if you haven't studied economics, it's hard to believe. You think I'm making this up because it's a good story. No, this is the truth. It is shocking. And of course, it's connected to, many of the developments that have been happening in the past century, some of which I will touch on in this presentation. So, banking, of course, is crucial. Anyone who has not studied economics will be able to tell you that banks are important and powerful, and therefore, of course, we need to understand how the monetary system works, and also we need to be able to answer the question, what is money? And we need to be able to define it, and I think we can define it. The textbooks can't. The textbooks say we don't know what money is. So today I'd like to talk about four things. Number one, where does money come from? Number two, what causes the recurring boom-bust cycles and crises that we're so familiar with? Also in Sweden, boom in the 80s, crash in the early 90s, massive recession, minus 4% GDP contraction. Good time to hold a referendum whether Sweden should join the EU, of course. And then boom again, bust again. So what causes these things? Number three, what sort of policies or systemic things, banking systems, have historically been most successful in avoiding those cycles and crises? And finally, therefore, what sort of system do we need and what should we do? How should we move forward from here? So, where does money come from? I actually launched a survey asking over 1,000 people in Frankfurt, which is the city of banks in Germany, and after London in Europe, probably the biggest financial center. And the question was, who do you think creates and allocates the majority of the money supply in Germany, of course, in that particular survey? And to make it easier, I gave them a few options. The government, the original survey, because it was in Germany, was more detailed than shown here. So the government, the Bundesbank, the ECB, the Landesbanken, which also exist in Germany, as part of the structure there, general banks, capital markets, money markets, the global financial infrastructure, you can get vaguer, financial markets. Now the majority, over 80%, replied the government or the central bank, putting Bundesbank and ECB together. Around 84% thought that either the government or the central bank creates the majority of the money supply and allocates it in the economy. That's, of course, a very reasonable answer. It's also entirely wrong, because 97% of the money supply is created and allocated by the banks. Central banks only create up to around 3% of the money supply in most countries. So the majority is created and allocated by banks. You may have thought that you know what a bank does, but I'm afraid if you haven't studied this already, as many of you may have done actually, a lot of the names and expressions in banking are quite misleading. We talk about a deposit of money with a bank, and we talk about borrowing money from a bank. So a lot of these expressions are not describing what's actually happening. When you go to a bank and you do what you think is borrowing money, the bank will not give you any existing money. It will newly create money. It will pretend that you as a borrower have deposited money, and that's how the accounts will be written. And that will be added to the money supply. And this is how the money supply is created. So the more banks lend, the more money is created, added to the money supply. And therefore the more transactions are taking place. And so you can see that, of course, it has to be at the center of the economy, what banks are doing. And of course they also make the decision who will get the newly created money supply. And that's of course why it's very important to make sure we have the right banks, such as savings banks, cooperative banks that work for the public benefit and not for profit maximization. What about all these other concepts that we've been told about? Is the ECB now going to engage in quantitative easing? Are central banks not creating a lot of money in the last 6 years since the crisis? We've had a lot of reports on that. But even then, despite all the central bank money creation, this is still a tiny proportion, around 3% of the money supply. If you're interested, I mean, when I introduced the concept of quantitative easing in Japan in 1995, I defined it originally as credit creation, as a measure to stimulate an economy that has been affected by the banking system crashing and the economy stagnating asset prices falling. It's a policy suggestion I made to get out of this crisis and recession. And unfortunately, the Bank of Japan refused to adopt this policy of expanding bank credit creation. But they quite liked the expression, quantitative easing, so they started using that 6 years later. But they actually didn't change their policies. They just did the traditional monetarist thing. They wanted to show that they're stimulating the economy, while actually they were not. So they, in order to show that they were doing something, they lowered interest rates. In 1991, interest rates in Japan were 7%. I was warning in the early 90s, you can lower those to 0. That's not going to help. The Riksbank has just lowered interest rates to 0. Well, it's not going to help. Why? Well, central banks tell you interest rates drive the economy. Don't trust their statements. Check for yourselves. Get some data out. It's very easy to check. Interest rates follow economic growth. And they're not negatively correlated, as they say, like low rates and high growth. That's what they say, right? High rates slows growth. No, there's no empirical evidence for that whatsoever. Interest rates follow growth, they're positively correlated. So whenever they lower interest rates, it's because the economy has weakened. Just following the economy. But why has the economy weakened? Well, because credit creation from the banking system had previously declined. That is the cause, and any policy has to address that problem. So when they do this quantitative easing now, it usually consists of expanding banks' reserves with the central bank, which again had warned in the early 90s was not going to help. It's not putting any money into circulation. Or it's getting the central bank to buy government bonds, which will help asset markets, but doesn't really help the economy. For that, you need bank credit to expand. And it matters who gets this bank credit. That's the money supply. The banks put it into circulation, and the banks decide who gets newly created money and for what purpose. And that will very quickly reshape the economic landscape. If it's given for environmentally destructive projects and for weapons production for the wars of this world, that's one outcome. But if instead it's decided, no, we want new money to be created and allocated for projects that improve public health, enhance the quality of life, and protect the environment, and therefore are sustainable in the long run, you get a different world. And the decision-making process is in the hands of the bankers. So they are very, very crucial. There's a very simple mechanism going on here to link this bank credit to what's happening in the markets. Bank credit needs to be separated into different flows. Basically, there's good flows, credit for good purposes and credit for bad purposes. Now, the first separation, disaggregation of credit, is when credit is used for transactions which contribute to the economy, to GDP. And that may not always be good or bad within GDP, but let's just do the first separation. Because it's also possible to create credit and it's not even contributing to GDP in a good or bad way. This is whenever banks lend and therefore create credit and it's used for transactions that are not part of GDP, namely asset transactions, financial transactions, property transactions. Whenever banks create money for the purchase of existing assets, ownership rights, it doesn't contribute to GDP. And that's where the national income accountants are right. GDP has many problems, but it's trying to add up transactions that add value. And of course, creating credit for financial transactions, buying and selling existing assets, doesn't add value. It doesn't contribute to national income. It does the opposite. Because all you're doing is, you're changing ownership. And it's a zero-sum game. If somebody wins in the financial markets, somebody else must lose by the same amount. And therefore, of course, it can't contribute to GDP. But if you have more and more people playing the stock market, playing against each other, of course, you must be reducing productivity in that economy. So it can only be a drag. So whenever you've got credit for financial transactions, it will not contribute to GDP, but it will have negative consequences. Namely, if we look at the right side here, credit used for bad things. The second one, credit for financial transactions, creates asset price bubbles, asset inflation, such as in Sweden in the 1980s. And that's not sustainable, from the beginning, because there's no generation of sustainable income streams to service the loan and repay the principal. All you have is capital gains. And they may last for a long time, like in the US, 2 decades even. While credit creation for financial transactions increases, these capital gains will continue. But as soon as it stops, the game is up. It's a game of musical chairs. Credit creation is the music. There are not enough chairs. While everyone is going round, the music plays. As the head of JP Morgan was saying, Chuck Prince, we're still dancing because the music is playing. But once the music stops, everyone is scrambling for the seats. There aren't many. So there will be bankruptcies. Asset prices will come down. And the banks will also go bankrupt because they have very little capital, only less than 10%. And so a fall in asset values, their loan values of 10%, means the banking system is bankrupt. This is, of course, what happened in Sweden in the early 90s. But in many countries and the recent crisis, it's always the same game. When credit creation is used for consumption, you get consumer price inflation. You create more money, but you don't create more goods and services. You create more money, therefore more demand for the existing amount of goods and services. You must get your standard inflation. So these are two examples, the two key ways of having unsustainable credit creation that is damaging for everyone, really, for society. But there is also good credit creation. That is when banks create new money and it's given for the implementation of productive things. Now, productive, of course, properly defined, widely defined, must include the environment. It must include issues such as public health and the quality of life. And when you do that, you are generating benefits for society, which yield a dividend if you want. So these also are loans that are sustainable. The return may not be very high, but it can be repaid because there are real benefits and income streams are generated. And you can get growth without inflation. That is sustainable credit creation. Just a few examples of when credit creation is used for the financial transactions, asset transactions. So then your credit is driving up asset prices. The graph here shows the Japanese data. Fairly similar in Sweden in the 80s, also in Japan at the same time. So the share of financial credit doubled from 15% to 30%. That's just to share. The total numbers were also increasing dramatically. But it was the same earlier in the 20s in the US, the bubble and then the bust and the Great Depression. The same in the Asian crisis in the 90s. And of course the same in the more recent crisis. And we can look at data in the Eurozone. Whenever, basically as a simple rule, whenever broad bank credit creation grows much faster than the economy for several years, what sort of figures are we talking? Ireland 30% credit growth for several years, from 2004 to 2007, while GDP growth is, well, certainly less than 10%. Well, this is money creation. Where is the money going? It's not going into GDP, because nominal GDP is growing by much less. It is going into financial markets. So whenever this happens, you know that's an asset bubble. It will have to come down. It will blow up the banking system. There will be a crisis. This is very predictable. The same in Spain. Bank credit growth between 15 and 20% in the mid-2000s. The same in Portugal. The same in Greece. In fact, I warned in my book, Princes of the Yen, in the last book, one chapter, I think around chapter 18 or 19, it's about the ECB. This is published in 2003. And I raised the warning that unfortunately we have to expect the ECB to create asset bubbles, credit bubbles, asset bubbles, and banking crises in the Eurozone. And this is exactly what it did in these countries. Just the data for Sweden here. The black line is bank credit creation, and you see that the bubble of the 80s started from 86 onwards. Bank credit creation rising by more than 10%, 15%, and then the crash, negative credit creation between 91 and 93. But you can also see that actually since then we had a few more cycles, and of course the most recent crash in 2009. So it's the same game continues to be played, and it's always amazing how the lessons don't seem to get learned. In fact, I sometimes get asked, so what's the lesson from all these crises? Well, the lesson is that the central banks don't want to learn the lesson. But which policy has actually, empirically, been successful in avoiding this sad story of massive financial and economic carnage and unemployment, dislocation, a lot of people losing their jobs? There are examples. The East Asian economic miracle, and here we're talking about Japan, Taiwan, Korea, and China, was based on a policy to target bank credit for productive purposes. The green box, the good credit creation. And the bad stuff, banks weren't allowed to create credit for speculation or for consumption. It had to be productive. And this was achieved through credit guidance, whereby the central bank monitors bank credit and basically disallows the dangerous stuff. And so people say, oh, that's an intervention in the free markets. Well, but in many countries, you're not allowed to carry a machine gun in the streets without an authorization. That's an intervention in the free markets, because there's a dangerous tool there that, things could go wrong if it's mishandled or used by the wrong people. And the same is true with money creation. It's potentially a dangerous tool, as history shows. And so, we need clever intervention of the right kind that prevents this being used to harm the public. And so that's a fairly good justification for this form of intervention in the credit markets. In fact, you can argue if you have intervention in that place, the decision of the creation, allocation of credit, you probably need fewer interventions in the rest of the economy, because that's really the crucial decision. And so we should remember that credit is always allocated, whether a central bank is watching or an authority is watching that it's the right credit allocation or not. There's always a credit allocation decision, because the credit market is not in equilibrium. And that means credit is always rationed, the short side has power to allocate, and that is the banks. Unfortunately, central banks don't have generally a good track record, and it was really a certain phase in Japan and Korean, Taiwanese and Chinese experience, which lasted for several decades. But in the end, even that system got undermined as the Bank of Japan abused its power and asked the banks to increase bank credit for speculation. So actually it confirms that this credit guidance is very powerful. You can use it for good purposes, but you can also abuse that tool. And so the Bank of Japan created the bubble of the 80s and then implemented the monetary policy of the 90s, which prolonged the recession. We're now in the third decade of recession in Japan and the fourth decade of disastrous central bank policy. So clearly we've got to watch central banks, and maybe it is risky of giving so much power to central banks, particularly if they're privately owned, such as the Federal Reserve or several other central banks, or basically very, very much aligned with large banking groups and therefore not working in the public interest. So, are there alternatives? Yes, there are. Let's think of a structure of the banking system that would achieve the same result as clever, good credit guidance, but without the need to do much guiding. So let's briefly think about small and medium-sized enterprises. Why should we talk about small companies? Weren't we talking big things here? Well, SMEs are very important. Actually, let me just do this slide first. They're the biggest employer in Sweden, in Japan, in Germany, in the UK, in the US. Small and medium-sized enterprises are the core of the productive economy, and their activity tends to contribute to stable economic growth. They account for usually between 20 and 30% of total investment, but between 60 and 85% of employment. So they are the main employer in most countries in the world. Why is that? Why are they such a big employer? Because they are job multipliers. A fixed amount of money invested in a small firm will create more jobs in the small firm than the same amount of money invested in or by a large firm. And that's due to economies of scale. It's what economists call efficiency. The big firms are efficient, so they don't need to employ people. But small firms create the jobs. And that's of course why they're very important. Now they are also dependent, small firms are dependent on banks for funding. They don't get access to capital markets, that's for big firms. So the biggest source of funding for these very important parts of the economy, the main employers, are the banks. Now, what about the banks? What types of banks are most prone to lend to the dangerous stuff? Large-scale financial speculators doing the financial speculation that you've seen creates asset bubbles and busts. Well, it's the large banks. It's an empirical fact that the following rule in banking applies. Large banks want to do large deals with large customers. Why? It's efficient. It makes sense, it's rational. You can't blame the bankers. They are being rational, they're being good bankers. But that means that when you have big banks, and when an economy is dominated by a small number of big banks, you will get mainly loans to big companies and not to SMEs. A crucial extreme example is the United Kingdom. There's 5 banks which account for 92% of banking, and they don't lend to small and medium-sized enterprises. The government has tried for many years to get them to lend to SMEs, give them incentives. No, they're not doing it. They're still shrinking their SME lending, and it's probably less than 3% of their total lending. Why? Well, it's so unattractive for them. They're large. I mean, if you're Lloyds Bank, if you're Lloyds Bank and you have a balance sheet of £1,000 billion, and you have shareholders that say you need to grow, you want to grow by 5%, so 50 billion is what you need to increase your lending, and you have an option to lend £20,000 to small firms, each £20,000. We need 2.5 million of those loans. There's a lot of work, too much work for the big bankers. They'd actually have to roll up their sleeves and, forget it. The alternative is much more attractive: to cut 50 checks to hedge funds that borrow £1 billion each. So that's what they're doing. That's what the big banks are doing. They're lending money to the hedge funds, private equity funds, for financial speculation, not for productive purposes. But there are examples of systems where these big banks are not dominant but small, and that is Germany. It's a prime example. These large banks that are perhaps getting the international headlines, Deutsche Bank, Commerzbank, they're only 13% of banking in Germany. The majority, 70%, is local banks. Two types: the local savings banks, Sparkassen, 43%, and the local cooperative banks, 27%. And in total, there's 1,700 of these small local banks. So certainly, a town like Motala would have one of them, and there'd be several in Linköping. That's the sort of structure. They have been under pressure in the last 20 years from the EU, from bank regulators. So they have merged, and their numbers have been declining, which is not good, because the smaller, the better. They tend to go under the same name: Volksbanken, Raiffeisenbanken, Sparkassen, but they're all legally separate companies, banks that make their own decisions locally, and they plow the money back into the local community. So that's really the policy solution. And it's something we can do where we don't have to wait for politicians to act, because just like the banks want to talk to big companies, politicians also want to talk to big companies and big banks, because they usually need funding and various other reasons. So these sort of changes don't happen top down. Historically, they've only happened bottom up, and that's what we can do. We can act immediately. So the creation of a network of local, small-scale, not-for-profit banks is how we can take the privilege of money creation back to the local level, give it back to the people to who it belongs. That is actually, of course, what banking looked like in most countries 150 years ago, also in the UK. But because banking is lucrative, when banks are up for sale, they will be sold. And so they merge and they become bigger. So banking, like many industries, but is particularly prone to concentration. So the problem nowadays is where we have many big banks dominating economies, centralization of bank operations, the loss of local knowledge, informed local decision making is not happening. There's no relationship banking often anymore. Focus on large-scale borrowers. That means also the unproductive financial speculative lending becomes more important, less job creation, and capital extraction from the regions. Bank branches then largely serve to collect deposits, but then actually money is being lent centrally, so maybe more in Stockholm to the fund industry and the speculators than all over the country. And the consequence is, well, you know the consequences, that we don't have a thriving local economy as a result. It could be much more thriving. And the banks do not consider the well-being of the local economy when they make their decisions. In the UK just last week, another announcement that Lloyds Bank is going to close another 200 branches because they're not interested in branches and they haven't used them to get to know local businesses. And so all that local knowledge is disappearing. We're now establishing the Hampshire Community Bank in Hampshire, in south of London. And the idea is that's a bank that focuses on local SMEs, micro businesses, social enterprises, lends productively, not for speculation, uses local deposits, so people locally know when they save there, their money is used for local purposes, generating jobs. It supports green projects and can become then an engine for local growth. And we want to make this a pilot, a model that can then be copied and rolled out in the UK, where savings banks were invented a long time ago, but they've disappeared. And we want to set up another new association of such community banks. It's a tried and tested business model. German history shows that it works very well. In the last 170 years, no tax money has ever been used to bail out a German Sparkasse or cooperative bank. Despite that, they're currently being forced to hand over a lot of money to the new European bank bailout fund, because of course the EU has had its eyes on their own internal security mechanism in order to transfer the money probably to Spain and other countries. Yep.
How come? Do you mean that they never go bankrupt, or how come
they haven't gone bankrupt in the sense, yeah, they haven't gone bankrupt. They may occasionally get into difficulties, but that's where the association, the corporation comes in, and they always arrange restructuring measures within the system. So other neighboring cooperative banks or Sparkassen will look at that. Okay, what can we do? How can we help? But at the same time, it's a good peer pressure mechanism, because you don't want to be the head of that savings bank that has to ask the other savings bank for help. And therefore, they are being very cautious. There's peer pressure. They audit each other and so on. So the idea is this would be not for profit, but is very profitable. Unlike the big banks in the UK, which are using offshore structures to minimize their tax payments, the Sparkassen in Germany, 400 now left. They've merged over time, but they're still paying a lot of corporation taxes, 3 billion. And they contribute to community life. In Germany, most of them are organized such that all their profits are returned to the local community. They do a lot of charitable giving. They support sports clubs, cultural activities, theater performance, education, social work, and. It all goes back into the local community. And because, of course, the basis for this is a public privilege, money creation, that's what should happen. The money should go back into the local community. I think I'm probably out of time, but I just want to wind up by reinvigorating local banking and establishing more local banks. We can get a lot of advantages. And even in countries like Germany, where there's still thriving local community banking systems, they have become bigger, and so we have to hold against that, and therefore there should be new creations of new local banks, because the smaller the better. Local banks, and sometimes we get questions, particularly in the UK, are not aiming to compete in a negative sense with other community support developments such as local currencies or in the UK small-scale credit unions. The idea is to be complementary. And so community banks would work, as we see this actually happening in Germany, quite closely with local authorities, with various local community enhancement schemes, with green and ecological investment schemes. Energy cooperatives are developing. This is a recent development where municipalities are taking the energy supply back to under their own control. They form cooperatives, and of course the local bank can be involved in that very productively. Community currencies, cooperation with local banks we can talk about that, enhance that. And of course monetary reformers are rightly criticizing the current system. This is a way of getting, in a way, a community currency. By having your own bank, you are creating money. And of course supporting also the cooperative movement and enhancing social justice. I think there's lots of advantages. What to do next? Well, we'll discuss this in our Q&A session. I hope we'll get some cooperation and perhaps get some European money for a European-wide project to enhance community banking. But I'd just like to finish by showing you two very brief clips. One is, let me just think about the order. Well, perhaps in terms of what I've just ended saying. Where is this now? It's disappeared. Oh, here, sorry. There is a clip on our Hampshire Community Bank. Now somebody switched this. One second, let me just quickly open this. The BBC did a bit of coverage. There's a 4-minute clip from the BBC on what we're doing. Okay, here it is.
Tonight's programme, the group planning on creating a new player on the banking high street, locally based for local people.
You will not be coming to work for our bank if you are expecting to walk away with a multi-million-pound bonus based on highly speculative leverage lending, which could go wrong.
Banks and those working in them have taken a beating over the past few years. Fat cap bonuses, the LIBOR lending scandal and crashes have all left confidence in the current system at rock bottom. A group of businessmen in the south are working on setting up a new bank based locally and only for people who live and work locally. It's being modelled on the network of local banks in Germany. Those behind the Hampshire Community Bank want to see a return to old-style relationship banking. Is our business correspondent Alistair Fee.
Meet the group who plan to change the face of banking. With backgrounds in finance, business and education, they have a vision to bring back lending, make money and transform the local economy.
The problems that we've had.
They call themselves Local First, and from an office in Winchester they're setting up a community bank for Hampshire.
It will be owned locally, it will do business locally, it will be there for the local community. It's basically exactly what's missing in the UK banking landscape.
To get a presence on the high street, the group needs a lot of money. They plan to raise £7 million. The hope is the government will match that pot of money, bringing a total of 14 million. But in their first year, they're expecting to lend in excess of 100 million. That depends on the people of Hampshire putting their faith and their savings in the bank.
The idea is you gather deposits locally and you lend locally, and I think people will like that.
I am concerned with the money that changes hands in this small town.
Banking was once all about relationships. As the industry grew, this was lost.
It's the sort of thing one must discuss with a man himself.
This movement is all about going back to how it used to be.
I would have about 50 customers, and I got to know those businesses really, really well. They would phone me up and say, look, I've got a bit of a problem this month. I need an extra 25,000 for a couple of weeks. Will that be okay? And I knew enough about what was going on in that business to be able to say yes.
So how would a local bank differ from the high street banks? Well, it would offer the same services with current accounts, credit and debit cards, loans and overdrafts. But it would be run by a charitable trust. The money the bank makes would be used to offer services that undercut the big banks.
Would you be tempted to perhaps move some money?
Well, the only thing that would tempt me is if you gave me a better rate of interest
We
for
will.
the money I've got.
It's got Hampshire written on the bank, then people in Hampshire will be like, yeah, I'll try it. So yeah.
I think it sounds like quite a good idea, if it's sustainable in business terms. I mean, clearly, it'll be a cash flow issue and an issue of trust.
We will be part of the government's compensation scheme, so all deposits will be protected up to £85,000. So that's the same protection that you would have by depositing with any big bank. You will not be coming to work for our bank if you are expecting to walk away with a multi-million-pound bonus based on highly speculative leverage lending, which could go wrong.
How the first bank grows and feeds the economy will be key to getting others interested. If they succeed, the ambition is for a network of local banks across the country.
Banking is actually a highly profitable business, and it's really a no-brainer for local authority to invest in setting up a local bank.
Eastleigh is the first local authority committed to investing taxpayers' money into the project.
Well, this isn't a quick fix. We're not talking about a traditional bank that lends to people for Christmas. We would hope that with Regional Growth Fund backing from government, we'll actually be able to start lending to businesses early in the next year. But the reality for the bank itself, with the regulatory process that we quite rightly need to go through and complete, we're talking about a year off.
How this develops is being watched with interest. Town councillors will meet the Business Secretary Vince Cable at a conference in Eastleigh next week.
They've got to be regulated properly, so they don't collapse. We don't want, people losing their money. It's got to be done on a proper prudential basis. But the more diversity, the better. And I certainly want the government to be supporting these experiments.
To get a banking licence, Local First needs the approval of the regulators. If they make it that far, the real challenge will begin to beat the high street banks at their own game. Alistair Fee, BBC South Today.
Well, Professor Richard Werner, who you saw in the film there with Alistair, is here with me now. He's part of the group trying to set up the community.
And finally, one more clip. This is returning to the theme of why we're experiencing these credit cycles and financial crises, and the role of central banks in that. There's a documentary coming out. The launch is tomorrow, so I think it's appropriate to mention that. It's called Princes of the Yen.
Mr. Maekawa, and you've guessed it, these are some of the princes of the yen that the book is all about. They have said on the record in the 80s and also throughout the 90s, what is the goal of monetary policy? It is to change the economic structure. Now, how do you do that? Well, you need a crisis, and that's really what they've done. They've created a crisis to change the economic structure.
Richard, we're just out of time. I have to cut you off. Thank you so much, and we apologize.
当時はですね、3ヶ月に一度ですね、要はどれぐらい活動金額を増やすかということを各銀行が割り当てられるわけですね。
バブルの原因は窓口指導なんですね。で、窓口指導は日銀が独立的に決めたものなんですね。
Well, it's a bleak Christmas ahead for Japan. The stock market on Monday sinking to its lowest close in over 2 years.
The story we're being told by the central banks just does not add up, and there is evidence that central banks work differently from what they would like us believe as to how they work.
And actually, a short version of this book was published in Swedish, called Mammons Furstar, which was published in 2003 as part of the campaign to get Sweden to stay out of the euro. So I came to Sweden at the time, and we were campaigning against We were just talking about that beforehand. Now everyone seems to pretend that they were all saying, you know, we should not join the euro. But of course, remember, all the media were saying you must say yes, otherwise disaster will happen. All political parties were saying you must vote for the euro, otherwise disaster will happen.
I'm very, very sorry.
Okay, all the major political parties.
Those who were in right was the major, I think.
But as I understand it, also the Socialist Party was also saying, I seem to remember all the main parties.
We can take that during
but,
lunch.
Okay, let's discuss that later. But it was clearly the majority that was pushing for, in the media and public opinion, for joining. But I was recommending for Sweden to stay out because the ECB was likely to be a disastrous central bank, and it was likely to create more of the same old game, credit bubbles, banking crises, recessions. And of course the ECB didn't waste a minute to prove me right on that one. So I'll leave my presentation there. I'm sorry if I ran over. Thank you very much.
Okay, thank you.